Hello, and welcome to the S&P Global Platts at APLA virtual meeting. Thank you for joining us. I wish, I know I speak for me and my colleagues when I say that I wish we could be there to meet with you in person, but 2020 has been an unusual year, to say the least. If you're not familiar with S&P Global Platts, S&P Global Platts is a division of S&P Global, the world's foremost provider of ratings, benchmarks, and analytics. Other divisions, in addition to Platts, include S&P Dow Jones Indices, S&P Global Ratings, and S&P Market Intelligence. S&P Global Platts is the leading independent provider of information and benchmark prices for the markets to deliver transparency and efficiency into markets in order to make decisions that they require to conduct their business. I'd like to take a moment to highlight the Platts Global Petrochemicals Analytics Service, where you can gain a view from our analysts on the global olefins and polymers outlook, the Asia aromatics outlook, naphtha outlooks. We also provide GDP forecasts, trade data, plant outages, operating rates, short-term outlooks, and long-term outlooks. All are available online via Platts Dimensions, Platts platforms. I'd also like to take a moment to highlight some of the work that we've done this year on the recycled plastics markets. S&P Global Platts launched several new assessments this year focused on U.S. Recycled plastics coverage, including new assessments for post-consumer bottle bales, which were launched April 1st, and recycled PET clear flakes, which were launched July 1st. We've also launched new assessments in Asia for clear flakes, recycled PET clear flakes, and Europe as well. So we now provide recycled plastics price assessments in markets around the world. For more information, please visit our website at platts.com. Today, I will be joined by my colleagues, Kevin Allen, who's the global lead for aromatics, Guilherme Baeta, who is the senior editor for petrochemicals based in Sao Paulo, Kristen Hayes, who's the global market lead for polymers, and Rob Steer, who's the senior lead for our global petrochemical analytics team. They're going to provide a number of discussions and interesting presentations on the way that this year has affected markets in petrochemicals. Guilherme is going to talk about Latin America in particular and how the recovery there has been driven by global markets. Kristen Hayes is going to talk specifically about the impact of the COVID-19 pandemic and global polymers. Kevin is going to give an overview of where North American aromatics stand. And Rob is finally going to provide an update on our outlook and offerings from analytics. Please stay with us for a live question and answer session following these pre-recorded presentations. Thank you, and I hope you enjoy our presentations.
Hello, my name is Guilherme Baeta. I'm the senior editor responsible for the Latin American petrochemical coverage at Platts. We're going to talk about Latin American polyethylene, polypropylene, and PVC directions, how the domestic markets regained its uptrend sentiment and consumption resumed. We'll briefly talk about how currency exchange is affecting exports and imports and economic factors across the region. In the main topics for 2021 in Latin America, we continue to see the historical relation between the US as a benchmark for the region when we consider polyethylene imports. However, with a limited supply seen the third quarter of the year. In terms of polypropylene, we see mixed imports between Middle East, Asia, and the US, but in a small percentage. In addition, we see a very important presence of Colombia and Argentina exporting to the region. For PVC, the region saw its prices reaching the record high levels during the past weeks, while Brazil became the most expensive PVC in the globe. In terms of the impact of international prices in Latin America, we are seeing current values rising following international levels, some reaching a record high during September and October. For comparison, during April and May, prices had reached its historical low record since Platts started assessing in 2010 and 2011. The coronavirus pandemic has definitely impacted business in the region. However, main consuming sectors are almost fully resuming some activity, therefore demanding more. For polypropylene, consumption is related to automotive sector, which is regaining activity, but also food packaging, same as polyethylene. Uh, PVC is well related to the construction and GDP market that are right now on the upward. A very important topic in the region has been forex depreciation and how imports would be affected by the situation. Since the beginning of the year, Brazil and Argentina were the most affected by forex. In this slide, we can see a graphic from Platts Analytics that shows the global net trade of polyethylene and its projections for 2020, 2025, and 2030. This is just for us to understand how the US market is very important in terms of supply to the Latin region. Of course, Latin American countries also import from Asia and Europe. However, the US is the most important in terms of setting prices trends in the region. I always show this graphic because it allows us to see in mathematic terms how the Latin American region follows the US. We can understand the correlation between the US polyethylene prices and the West Coast and Brazilian imports. First, on the upper left, we can see low density polyethylene in the West Coast compared to fast Houston. There is a very high correlation between prices movements. So most of the times when prices move in the US, it also moves in the West Coast for that product. It is the same below, as you can see, for high density compared to fast Houston. On the right, we can see Brazilian CFR prices that are very well correlated to US prices movements as well. This graphic is just for us to understand that the Latin America market is very well connected to the US market in terms of pricing. So whenever US prices are on a downtrend or uptrend, the Latin American market is somehow attached to it. On this set of slides, we'll see perfectly how Latin polyethylene directions are driven by the US, which is represented by the blue line in all graphics. Starting with high density polyethylene blow molding, we can see that both orange and green lines representing Brazil and the West Coast follow most of the movements of the blue line. The yellow line, which is Asia, can be seen sometimes even higher in terms of prices than Latin America. Asia market has the lowest prices currently, but due to high freight rates, it turns not to be so competitive. Here is just for us to understand and see the updated expectations of Platts Analytics for the region concerning the coronavirus pandemic impacting the Latin American markets. On the right, on the left, I'm sorry, we can see the divided per producing country, the install capacity and the likely run rate for 2020, 2021, and 2022. Well, these are run rate expectations for Latin American countries, with most of them decreases expected for all countries in all products. Of course, this is a global trend, downturn of run rate due to lower demand. We can see some recovery in 2021, but still lower than 2019 levels. Even for 2022, the expectation is lower than 2019 in some cases. On the right, we see demand estimative for this year and the next 2 years. We can see some drops in Argentina and other non-producing countries, while most of the markets have some growth in high density, related mostly to food packaging, which was a sector that was not so much affected by the pandemic. For low density polyethylene, it is very similar. Brazil and the green lines, they're very well correlated to the blue movement, which is the US. We can see some shifts in prices from the US and Asia, and now the US is the cheapest market worldwide. The yellow line represents Asia, is the one that does not follow the other three, as we can see, while the green orange representing Latin American markets follow almost every movement of the blue one, the US. What does that tell us? Well, that the US continues to be the benchmark for the region in terms of polyethylene. Again, for us to see low density polyethylene capacity and run rate expectation for the region, we can see some of the same downtrend for Argentina and Brazil, with Mexico resuming its regular run rate expectations of 2018. We know that Venezuela hasn't operated in the past years. On the right, we can see demand increase of the Americas. We note some decreases or small recoveries, of course, but compared to what we had as previous expectations when the pandemic starts in April and May, most of the numbers are more positive, as demand, consumption, and activity resume for most of these sectors. Finally, linear low polyethylene. We can see some shifts during the pandemic, and spot Asian prices in the yellow line even higher than Latin American prices, which are orange and green. The US, of course, is the cheapest for that product in most of the time. The Latin American countries follow, if you pay attention, they follow very much the same movements with some delays. Latin countries can see a week or two of delays in terms of pricing movements from the US. It always depends on demand, booking, loading, payment terms, but they follow the same pricing movements generally. Again, we can understand low linear low capacity and run rate expectations for 2020, 2021, and 2022. These numbers are attached to GDP expectations for each country and its economic situation expected for the period. Brazil is expected to have a slower recovery for the period when compared to Argentina and Mexico. The question is, has this drop for these markets already stopped, or we could see continuous downtrend for the region with a second wave of COVID-19, which has begun across Europe now? The run rate cut will be largely for 2020 as expected, recovering as soon as demand starts to pick up again in 2021. But at this point, it will depend on how long the quarantine and economic crisis could endure. Demand estimative shows mostly the same as high density and low density, with some drops expected for Argentina and other small countries, but mostly stable when some recoveries across the region. In this slide, we can see another graphic from Platts Analytics that shows us the global net trade of polypropylene and its projections for 2020, 2025, and 2030. This doesn't account much for trade flow, as Asia and the Middle East are very important in terms of exports to the Latin region, but shows us the net trade of Latin America in general. We can see the high offer Middle East has compared to the other regions, which makes them the most competitive for PP. Here talking about the Latin polypropylene market and how the trade flow actually works in terms of prices. Middle East and Asia are the most competitive players of polypropylene and have the most competitive prices globally. It's mostly the cheapest option. Depending on freight rates and handling costs, it can be sometimes more expensive than local offers, but it is often the cheaper. Argentina is very competitive in homopolymer in the region, being the largest exporter to Brazil and the Ruhr region. Its prices are not the cheapest, but it doesn't have to face any importing or exporting duties. Colombia, it's a very competitive in copolymer products, and it exports a lot towards the region with very competitive prices. Sources had said that Essentia, formerly known as Propilco, had been very aggressive in terms of prices and market share lately. Brazil has the production of Braskem. Domestically, it holds around 70% of the market share. So Braskem is very competitive domestically. However, not so much in terms of exports. It does export to the Mercosur, Argentina, Uruguay, and Paraguay. And the US is the less competitive in terms of polypropylene, with the least volume sold in the region. However, during the pandemic, as we can see in the graphics, we saw some shifts in prices and saw the US even cheaper than Asia. In the graphics below, we can see in the PP homopolymer on the left that in comparison to the green line representing the US, the orange and yellow lines representing the Latin region, it does not follow the same trend. We can see that US prices are even higher than the Latin American values due to the low offer in the domestic US market. Asia in that graphic is represented by the blue and purple lines. If we look to the right on the copolymer graphic, we'll see the highly correlated lines working together in all cases, except for the purple line, which is the US. At the higher end, we see Latin America in green and orange, and the rest we see Asian exports, the most competitive prices regularly. Once again, we'll see the expected run rate and capacity for 2020, 2021, and 2022, but now for polypropylene. On the left, we see some expected recoveries across the region for Argentina, Brazil, Chile, Colombia, and also Mexico. On the right, however, we can see a drop for all major countries in the region. And I ask you, why is that different for PP than it was for PE? Well, most demanding sectors for polypropylene were industries that were hit the most, such as the automotive, which is there. It is mostly present in Brazil, Argentina, and Mexico. We'll talk a little bit about PVC now. In that market, Asia is the most competitive in terms of prices, but high freight rates and limited supply sometimes make it as not the best option, especially when we consider delivery times. The US is the benchmark when we're talking about the west coast of South America. As we can see in the left graphic, the orange line representing the west coast follows the fast Houston in every move. The US, however, is not that important to Brazil because the country faces anti-dumping duties, which makes prices not so much competitive. Europe, on the other hand, is more expensive than Asia, but its freight for the region is cheap. We can see the relation of pricing movements of the, the graphic on the right, representing Brazil in the orange line, and the European, Turkish, and Asia prices on other colors. It is worth mentioning that the current Brazil level of prices, it's all-time high since Platts began assessing that PVC market in 2011. The west coast of South America is a nine-year high. Also, the same year, 2011, when Platts started assessing a year ago, a year below in 2010. Here, just for us to understand a little bit how Forex impacted the Latin American market this year. Well, mostly because some important countries have seen their currencies depreciated strongly against the US dollar. That affects those countries because it reduces the purchase power of each currency, therefore making the domestic product sold in each particular local currency more attractive, definitely. We can see that the most affected were Brazil at more than 44% if we compare to the beginning of the year. Argentina was the second at almost 31%, and followed by Colombia with 17.4% of depreciation. Chile and Peru had smaller depreciations, while Ecuador had none, as its currency, official currency, is the US dollar. So I end with this question. Is consumption regained all its volumes in Latin America yet, or there's more run to recover in the coming quarters? Well, we'll see that because volumes so far have indicated that prices have not started a recovery scenario that, the only concerning issue is a possible second wave of COVID-19 for the region. The whole market expects the vaccine for the first quarter of next year, and if that delays, then we can see consumption being impacted again. We can see Forex could indeed continue to impact imports at the same time as domestic producers rises their values. However, greater availability of products are on the way. In terms of local prices dynamics, we see Argentina taking consideration the exchange rate, international prices, and a premium of around $100 to $150. Argentina also is seeing the most expensive values in its domestic prices since Platts started to assess these markets. Brazil domestic markets taking into consideration the exchange rate and also international prices, plus of course demand and consumption. So Brazil actually has the most expensive prices, record high prices since Platts started covering the domestic markets as well. Colombia, on the other hand, takes into consideration values of the West Coast, import safety of nationalization costs. Mexico is more connected to the US dynamics and local production costs. We saw actually during the pandemic, Mexican prices even lower than the US in some cases. As talked before in the region, the most affected industries were the automotive, with most plants suspending activities across the region, and the construction sector, which affects the most PVC, highly related also to construction and GDP. What leads to the not so much affected industries, which are food packaging and health and medical industries. Plastics for those industries were considered essential by local governments, and demands for those products were or stable in the food chain or even higher in the case of health and medical. The greater expectation is a world free of COVID-19 by the first quarter or second quarter of next year. However, I end with this question. How long until the situation normalizes at pre-COVID levels? It is very hard to have that answer, but we'll definitely see in the coming months, in the coming quarters, how each country in Latin America will behave. Well, we'll have a Q&A session at the end, so thank you. And every question and every doubt that you have, please don't hesitate in contacting us.
Hello, I'm Kristen Hayes, the Global Market Lead for Polymers at S&P Global Platts. I'm glad we could all meet again for APLA, though we're all continually adjusting to this virtual COVID world. And speaking of, I'm going to take you through how COVID has affected global polymer pricing. I'll also discuss how COVID has affected major U.S. projects under construction, many of which will produce export-bound material. We'll also have an update on global ethylene prices and U.S. ethylene export growth. So here's a look at global HDPE prices so far this year. The U.S. began 2020 with a great deal of oversupply and pressure to export. As you can see here, Asian pricing fell from January levels through February, March, and early April as the region faced the first global wave of COVID. As shutdowns spread to Europe and the U.S., those prices fell as well. As shutdowns eased, prices rebounded, and you can see U.S. pricing rose to the top in late August and early September. That is thanks to Hurricane Laura's assault on Louisiana on August 27th, followed by Hurricane Delta 6 weeks later, taking virtually the same path. Major Lake Charles, Louisiana producers, including Sasol, Westlake Chemical, Lotte Chemical, and LyondellBasell, faced weeks of outages after Laura severely damaged major electricity transmission lines that had to be rebuilt. Delta was weaker and caused less damage, but interrupted restarts. Now we see a more dramatic slide for polypropylene prices in March through May. PE prices have been largely resilient because PE is used to make so many single-use plastics that have remained in demand. While PP demand for non-woven plastics for medical masks and gowns shot up dramatically amid COVID for obvious reasons, that pull wasn't nearly enough to overcome lost demand when major vehicle manufacturers across the region shut their plants amid the height of overall COVID-related shutdowns. But when those plants reopened, prices rebounded to pre-COVID levels. U.S. prices reached a 23-month high again because of the hurricane fallout that siphoned supply. In the U.S., export polypropylene availability has been largely nil for weeks. PVC, of course, is quite vulnerable to economic shocks and retreats in GDP growth. This slide shows how PVC prices fell sharply when COVID hit and construction activity stalled. However, when shutdowns eased, prices snapped back as buyers sought to catch up on those lost months. Demand strengthened and supply tightened as producers maintained reduced rates for various reasons. Those include uncertainty about how sustainable the renewed demand would be, particularly if fresh waves of COVID infections prompted more shutdowns, as we're seeing now in Europe. More recently, producers have been wary of raising upstream chlor-alkali rates because of weak global demand for caustic soda, and they want to keep those inventories in check. Still, construction demand has remained strong, And in the US, that strength stems largely from consumers wanting single-family homes. The thought of an airborne pathogen floating around a high-rise's shared ventilation system has fed that demand, as well as the specter of working from home for much longer than anticipated. US PVC prices have even surpassed US HDPE and LLDPE prices twice this year, which is rare. Early in the year, PE oversupply weighed down PE prices below PVC levels. Later, as you can see, PVC even surpassed LDPE, which always maintains a premium given that it is more expensive to produce, in addition to being in tight supply. However, this window of PVC strength is really not expected to last long. It's largely supply driven and it is not long term. While single family housing demand is strong at the moment, PVC demand seasonally wanes during winter months and when construction activity slows. Also, a great deal of uncertainty remains about the future health of office space construction in the world of COVID. While your neighbor may bolt your high-rise or apartment complex to buy a house, that same neighbor may be working from home for a year or two, or perhaps permanently. So let's move on to PE exports. Those low PE prices in early 2020 caught China's attention, as you can see by the level of US material that flowed into China through August this year, despite 25% tariffs that remain in effect. From 2017 through the 2020s, more than 15 million metric tons a year of new PE capacity has either started up, is under construction, or planned. Pretty much all of that is export bound, and China is a very important destination given its expected demand growth. Here's a look at export routes for US PE. Houston is home to the second largest petrochemical port in the world behind Rotterdam, and easily dominates these outflows given the proximity of so much production. However, you can see from 2017 through last year how other ports have gained a share of this growing pie of US PE. They have enticed resin packaging companies to open nearby operations to encourage producers and traders to move resin hundreds of miles from Texas and Louisiana to export from Los Angeles and Long Beach on the West Coast, and Charleston, South Carolina, and Savannah, Georgia on the US East Coast. This ensures some pellets are always in motion, whether or not the Gulf Coast gets hit by fog shutdowns, hurricanes, or other issues. And now we'll move a bit upstream to look at global ethylene prices. Asia and Europe saw this pretty dramatic plunge in ethylene prices in April and May, thanks to the global oil price crash, when demand fell sharply amid shutdowns and that ill-timed price war between Russia and Saudi Arabia was ongoing. Cheap naphtha led to cheap ethylene, narrowing that ethane-fed advantage in the US. Throughout discussions of first quarter earnings, US producers were asked if there was any concern about this narrowed advantage, and perhaps would they want to convert their ethane-fed crackers to run naphtha or increase naphtha cracking capability in flexible crackers. Overall, the answer to that was no. Producers were confident that the ethane advantage would return, and it did, as oil prices inched up. You can see the advantage narrowed again in September, less dramatically because of hurricane-related shutdowns and some other operational issues. And then again, it widened. Now for a look at rising US ethylene exports. Enterprise Products Partners shipped out its first ethylene export cargo from a new Houston Ship Channel terminal in January this year, and you can see how dramatically those outflows have risen. The new terminal will have a capacity of 1 million metric tons a year by the end of 2020, when a refrigerated tank comes online in December. Before this terminal opened, the US had a single ethylene export terminal with capacity to ship out only up to 300,000 metric tons a year. So now a look at US petrochemical projects, most of which will be producing export-bound material that face delays because of COVID. It's pretty tough to social distance when you have hundreds of contractors on site. So these companies suspended or slowed work to reduce personnel on site at any given time, and some put off final investment decisions. As you can see, startup dates have been pushed up to a year because of these delays. And now a bit more on the hurricanes as we continue to see their fallout in markets. The US Gulf Coast and the US East Coast, for that matter, are no strangers to powerful storms. Hurricane Harvey drowned the Texas coast 3 years ago, causing widespread shutdowns of plants, ports, and railroads for days and weeks. But we hadn't seen anything that serious until Laura. Harvey was all about rain that just kept coming, reaching unprecedented levels. Laura was about wind. a Category 4 storm with 150-mile-per-hour winds, which is only 7 miles per hour under the bottom range for a Category 5, the kind of storm that can mangle steel and level buildings. Lake Charles, Louisiana took a direct hit from Laura, while Houston was barely affected, and Beaumont, Port Neches, and Port Arthur in southeast Texas recovered fairly quickly with a few exceptions. Delta was weaker, as I said before, a Category 2 storm with 110-mile-per-hour winds, and did not cause the same kind of widespread damage to major electricity transmission lines in Lake Charles. However, plants that had restarted had to shut down again as Lake Charles took its second hit in 6 weeks. And here is the fallout. Many of these damaged major electricity lines had to be rebuilt, leaving major petrochemical operations offline for 4 to 5 weeks as they awaited restoration of full load power. While they could see little notable damage to the eye from their complexes, what they really needed was the kind of power to fully test their systems before trying to restart. So these force majeures listed here on top of previous non-storm related force majeures earlier in August. This is why you're seeing prices for PE, PVC, and PP showing such strong spikes in September. In addition, Hurricane Zeta came ashore October 28th in New Orleans as a Category 2 storm. Lake Charles was spared a third punch, but major operations along the Mississippi River north of New Orleans were outside the storm's path as it crossed through the city and went into Mississippi and Alabama. But Olin, the world's largest chlor-alkali producer, declared force majeure on October 30th on all products at its McIntosh, Alabama chlor-alkali complex when power outages left that complex idled. And just to note, the U.S. Atlantic hurricane season officially ends November 30th. And the U.S. isn't the only one with multiple FMs that have had global effects. These 3 producers in Europe declared FM on PVC for various reasons in September and October, further tightening global supply. Just a quick update on the status of new ethylene capacity in the U.S. These projects were all in the first wave of new builds to emerge from the U.S. natural gas shale boom, and all of them are up and running. Here's more ethylene capacity to come in the 2020s. CP Chem and Qatar Petroleum delayed FID of a new cracker on the Gulf Coast, likely in far southeast Texas, to 2021. Motiva Enterprises also put its new cracker project on a back burner indefinitely. Motiva bought a merchant cracker from Flint Hills Resources in 2019, and their focus changed to use what they already have while gauging when and if to build a new plant. And with the new crackers comes new PE plants. All of these except the new LDPE plants at the bottom are fully online. Of these new LDPE plants, Formosa's just began starting up right at the end of October, and Sasol pushed its full startup into November this month, mostly because of the interruption with shutdowns because of Hurricane Delta. And here is what's to come in PE from this year on, though some, like the CP Chem Qatar and Motiva projects, could be delayed even further. And here is why the U.S. built all this new capacity and is building more. It's about using that cheap ethane advantage to become a world supplier. The U.S. and the Middle East are the supply centers, and Asia, led by China and India, is the top demand center. Central and South America, incredibly, are very important demand centers as well, particularly for the U.S., which dominates these flows given the proximity. Africa is a growing demand center, but clearly Asia is the big target, and the U.S. has to compete with well-established Middle East flows for that prize. Just a quick look at the U.S.-China tariff war. While there was a phase 1 deal signed in January between the two economies, it involves mostly agricultural crops and vehicles, and targets have not been reached given COVID-related interruptions and flows earlier this year. Tariffs imposed on petrochemicals in 2018 remain in effect as they were. China has lifted 25% tariffs on some specialty grades of HD, LLD, and polypropylene, but these make up a very small amount of U.S. outflows. So key takeaways: PE has overall been more resilient to demand declines than polypropylene and PVC, given the single-use versus durable difference between the two resins. That said, PP and PVC prices have roared back, largely on supply-driven issues as well as stronger demand. Uncertainty about the sustainability of that strength remains. COVID slowed constructions on major projects and prompted delays in some FIDs, but most of that slowed work has resumed at a normal pace. and tight resin supply is expected to last through the rest of 2020, while early 2021 should bring a return of the PE oversupply when output normalizes, unless COVID has other ideas. So, thank you for your attention, and here's to weathering this COVID storm together. And now I'll hand it off to Kevin Allen, our global market lead for aromatics.
Good afternoon. My name is Kevin Allen, and I am the Global Aromatics Lead with S&P Global Platts. I'm based out of Houston, Texas. I've been with the company for about 11 or 12 years now, and today I was going to talk briefly about the North American aromatics market, just a bit of an overview and what we expect to see during the first half of next year. And I hope you find it informative, and I hope it leads to some useful discourse. For my agenda, I'm going to start by talking about some of the pressures that the U.S. aromatics market has faced. These are pressures that existed prior to the pandemic. They came in the form of capacity growth, primarily in Asia. I will go on to talk about the COVID-19 pandemic and its impact, as well as crude oil production increases and how these factors have kind of exacerbated pressures on the aromatics market. From there, we'll look into impacts on toluene and mixed xylenes, talk about how prices have gravitated towards gasoline. We'll do the same for benzene and styrene. We'll look at the impacts there and examine some capacity growth. And then I will wrap it up by talking briefly about our near-term expectations for the U.S. aromatics markets as we begin 2021. Now, as I mentioned, there was some pressure on the U.S. market prior to the pandemic, and that pressure comes via vast capacity growth in Asia. This slide shows global paraxylene capacity increases, but globally between the years of 2019 and 2020, PX capacity is expected to grow about 12 million tons. If you look on this graph there, the blue line represents China, which constitutes the majority of the growth. A lot of that growth comes from these so-called mega refineries, the crude to chemicals refineries. But the outcome is this significant growth is going to create a supply glut for paraxylene, and that's expected to persist for a couple of years between 2020 to 2022. As a result of all this excess supply, paraxylene prices in the U.S. and across the globe, for that matter, have been pushed lower. We don't expect these dynamics to change until probably late 2022 or early 2023, when we see a vast expansion in PTA capacity in Asia, where nearly 20 million metric tons will come online by 2023. This growth isn't confined just to paraxylene and PTA. We've seen similar growth in benzene and styrene as well. Again, these blue lines here represent growth in China. So much of the growth is happening in China. And on the left, it shows the benzene capacity increase. But between 2020 and 2023, you can see a little more than about 5 million metric tons of new benzene capacity coming online. The graph on the right shows styrene capacity increase. You can see during that same period, you can see even greater growth in the styrene markets. So this capacity growth and pressure is not just confined to PX and PTA, it's also in benzene, styrene, and several other chemicals. What's interesting about this one is that the timing for the styrene capacity increase is such that it will consume a lot of the benzene and kind of it will avoid creating a supply glut in the same way we see with paraxylene and PTA. Some of the other factors that are weighed on the market in 2020, obviously the pandemic has been huge. In late 2019, you saw COVID-19 cases begin to emerge in Wuhan, China. By January, February, March, those cases had spread throughout the Americas, Europe, Latin America, Basically, they'd spread globally. One of the kind of byproducts of this virus was the associated lockdowns. People began to work from home, shops were closed, restaurants were closed. So the virus itself actually put a serious dent in gasoline demand in the US. And if that wasn't bad enough, during March, crude pricing across the globe fell sharply amid a price war between Saudi Arabia and Russia. Saudi Arabia announced that they were going to increase crude production, and that pushed prices down sharply. We saw refinery utilization rates fall in the US below 70% in early May. And then finally, we had a really bad storm season along the US Gulf Coast to the point where they ran out of names and just started using Greek letters. But the Lake Charles area was hit twice in 1 month by 2 different hurricanes. That impacted several producers there. But overall, 2020 has been a very rough year, not just for aromatics and not just for petrochemicals. It's just been a rough year for everybody, right? But you have capacity growth, you have a pandemic, you have dropping crude prices, and you have the storm season. So it's been really rough for aromatics makers in the US. Now, if I can put it in a different context here, I took a snapshot of the NYMEX crude futures. And if you look, that first one for May 2020, on the last day of the contract, they would have paid you $37.38 a barrel to take oil off their hands. So oil went negative, and not just like slightly negative, it went sharply negative. As a disclaimer, again, this occurred on the last day of the contract, and people had to, kind of dump volumes. So it was somewhat abnormal, but the fact that crude was negative at all was pretty shocking. If I change that context and I look at the forward month and the June 20 futures, they were $20.35 a barrel. That's worth less than a family-sized bucket of chicken at a fast food restaurant. So crude prices took a beating and basically dragged down the entire aromatics complex. So yeah, again, a very rough year for chemicals in the US and aromatics in particular. What does that mean for toluene and xylene? Well, collectively, these factors just beat down the US toluene and xylene markets. We saw prices gravitate towards RBOB, and the spreads between toluene and xylene narrow in Q2. This graph shows the toluene MX premiums to RBOB, and if you look on the right side, at one point they were probably close to 90 cents in April. Shortly thereafter, they fell down to 20 cents. So you saw a 70-cent decline in the premium for these blend stocks. Demand was really thin. We saw buy interest from some gasoline blenders. The people I talked to said that bids were 10 cents above referment, and that's generally too low for a producer to want to extract. So there was very thin demand, and it was at low levels, and it was primarily from gasoline blenders who were seeking a good buy. We saw these premiums rebounded again late in Q3 and early Q4. But again, that's due to unplanned outages, mostly tied to the hurricanes and storms that hit the US Gulf Coast. But overall, the weaker pricing across the aromatics complex has affected chemical demand. We didn't see a whole lot of demand this year for toluene conversion margins or toluene conversion units. You can use toluene as a feedstock to create benzene and paraxylene through a process called disproportionation. The people who run those units, we saw the lower run rates sharply because of poor economics. This graph shows the toluene conversion margins, the STDP margins in blue versus the blend values. And if you look at those blue lines, you can see that for the most part of 2020, they're negative, right? There was a jump in Q2, but that's kind of an anomaly tied to the sharp decline in prices across the chemical segment and energy as a whole. And what that tells me is the toluene price, the declines just kind of outpaced the other aromatics because it looks like there's a margin there, but there was no demand at the time. So it's an anomaly for sure. We did see economics improve a bit in the fourth quarter, and that's been due to stronger benzene prices. We expect that to persist through the remainder of the year. But if you look at it from the beginning of 2020 and just look at it as a whole, economics have been really poor and margins have been poor. Toluene carried a premium to benzene of about 9.6 cents in the second quarter. That premium shrank to 8.8 cents in the third quarter, but you cannot produce benzene from toluene when the toluene is more expensive than the benzene. So you didn't see a whole lot of demand from these toluene conversion units, which put demand squarely in the hands of gasoline blenders. I'm going to move on to US benzene and styrene real quick. Basically, you saw similar declines in the benzene and styrene markets. They were not immune to the impacts of these capacity growth, the pandemic, and the energy complex. Prices fell pretty sharply in the second quarter. In 2020, styrene saw a little more support due to planned and unplanned outages. As I mentioned earlier, there was the Lake Charles area was hit twice in 1 month by hurricanes. Westlake is a styrene producer there. They were taken offline in late August following Hurricane Laura. They ended up declaring a force majeure, which was just recently lifted. And then Total and Sabic's joint venture called Cosmar has carried out planned maintenance in October. That's expected to start up again around mid-November, as I understand it. But the absence of availability has helped support pricing and kind of mitigated some of the declines. And then on top of that, we saw some strong export demand in the fourth quarter that kind of helped prop up styrene prices, and it's also helped pull benzene prices higher as well. On the supply side, domestic benzene production has been curtailed. Again, because of the lockdowns and the reduced gasoline demand, you saw lower refinery run rates. I mentioned earlier they fell below the 70% mark in the second quarter. If you extrapolate down from just general refinery run rates to the reformer, and you consider that there's I don't know, close to 5.5 million metric tons of benzene capacity from the reformer, and you can do the math and assume that every 10% reduction in reformer rates takes about 43,000 metric tons of benzene out of the market. And so you saw less benzene come out of the reformer. And then, as I mentioned earlier, you can produce benzene and paraxylene by using toluene as a feedstock. The slide I just showed demonstrated how those economics were poor. So those unit operators were running at reduced rates just to meet contractual obligations, not trying to produce incremental tons by any means. So you saw less production in the US from both the reformer and toluene conversion. If you look further downstream, the derivatives for benzene, styrene were mixed. Phenol demand has been pretty terrible all year. Polystyrene demand was stronger in September and October. It's probably going to taper off just due to seasonal demand reasons. But styrene itself is still showing some strength, as I mentioned, due to exports. Just to talk a little bit more about that, I mentioned, polystyrene demand was pretty seasonally strong in September and October, but some of the other styrene demand or derivatives were weaker. ABS was weak, SBR. So the exports really kind of helped, and what drove the interest in U.S. styrene was, in one part, it was a delay in new capacity startups in Asia, and that was coupled with a decrease in Chinese inventories. You can look back, even back towards, August, you can see the inventory levels were, near 240,000 metric tons, and this is South China alone. By just this past month, they fell down to 180, and I think they were down to close to 160,000 tons last week. So the lower inventories coupled with the delayed startups in Asia prompted a lot of buy interest, and that spurred a lot of liquidity and activity for styrene in the U.S. In November, we saw transactions that totaled around $100,000 fixed, or 100,000 metric tons fixed. Most of that material was for November. There's about 60,000 tons for November, and another 20,000 tons were fixed for December loading. We expect that similar numbers in November, though maybe not quite as strong. But the primary destinations for these traders is the west coast of India, Turkey, Korea, and the Far East. But it's been a strong month in October for styrene exports, and it's expected to be pretty strong in November. And that's kind of helped lend more support to both styrene prices and benzene. So now that we've kind of seen what's happened, what do we expect to happen headed into 2021? We don't expect to see a whole lot of change. I mean, the pressure points that existed previously will persist. Again, Asian capacity growth is going to keep pricing depressed for a lot of products, particularly like things like paraxylene. This graph shows, some of the new capacities, and if they all come on as expected, there should be around almost 19 million tons of PX. That's going to put a lot of pressure on pricing globally. It hurts economics for U.S. producers, and we expect to see a lot of paraxylene imported or continue to be imported into the East Coast. We think that the market's going to remain in balance until the downstream PTA units come online, which should be late 2022 or 2023. And as I mentioned earlier, there's a lot of new benzene capacity, but it is coming online in conjunction with styrene capacity. So we think that that benzene will be consumed by the styrene segment, and if any impact would be that previous styrene imports might be displaced. But that's all contingent upon how things in the downstream styrenics chain run, because there are new ABS capacities and new polystyrene capacities as well. On mixed xylenes, because we expect to see paraxylene soft, we don't expect a lot of strong demand from the chemical segment for mixed xylenes. The PX-MX spread has been pretty weak. It's been, I don't know, anywhere between $40 to $60. Usually producers who run crystallization units or Parex units want, I don't know, ideally $100 above the MX price. We don't see that happening anytime soon due to the length in PX, so we think those spreads will remain weak, and those unit operators will run at reduced rates. That's going to leave MX demand confined largely to the solvents and gasoline segments. Given a recent resurgence in the pandemic, we expect gasoline demand to be pretty soft, at least for the first half of 2021, if not throughout the year. We expect the economics for mixed xylenes to stay the same. We don't expect premiums to reformate to increase vastly in the first half of the year. And again, this will remain the case until the late 2022 or 2023. For toluene, again, we expect similar dynamics. We expect PX to remain weak. That's going to weigh on toluene conversion units, so we don't expect a lot of uptick in chemical demand. We think the STDP unit operators will continue to run at the whatever base rates they need to meet contractual obligations, but don't expect them to see them running harder. At this point, the largest demand segment for toluene is likely to be gasoline. So we expect pricing to move in line with gasoline until the paraxylene PTA issue balances out. There was a recent ruling by the EPA that streamlined compliance for reformulated gasoline, and that allows for increased reformant blending, but we're not expecting it to have a significant impact on toluene as a gasoline blend stock, mostly because at the moment there's a lot more gasoline and a lot more blend stock availability than there is demand. So because of that, we expect extraction spreads for toluene to also remain soft. On the other side of that, supply is expected to improve in the fourth quarter. As I mentioned earlier, the Lake Charles area was hit by a couple storms. Citgo has some capacity at Lake Charles, and their toluene production, I think, is about 400,000 metric tons a year. Their mixed xylene production is about 500,000 metric tons a year. That capacity is going to come online in November, and that's going to put some more downward pressure on pricing. So we expect to see slightly softer toluene pricing heading into the first half of 2021. On benzene and styrene, we don't expect production to increase in the US. And again, this is tied to weaker demand for gasoline and jet fuel. We expect refinery utilization rates to remain low. And this is all directly tied to the COVID pandemic. For the remainder of this year, we expect benzene to tighten a little bit. We're seeing lower exports to the US out of Korea. Korea is the largest benzene exporter to the US in the world. They've decreased exports to the US and kind of redirected some of that material to China. So we think that the market could tighten a little bit. And if you couple that with increasing demand from the downstream styrene makers, we expect some stronger pricing and weaker availability. As I mentioned earlier, styrene is pretty strong. We've seen export fixtures loading into November and December, so we expect that to remain the case in Q4. And this will be tied to strong demand in Asia and South Asia. And as I mentioned earlier, low inventory levels. On the supply side, we expect things to improve a bit. Westlake has already restarted their unit. The Cosmar joint venture should start in mid-November. And that's going to put a lot of downward pressure on styrene prices. Related to the new capacities in China, it's not immediately clear, but we expect that once those units come on, those could shift some trade flows. It could displace historical imports. But again, that depends on how the ABS, SBR, and polystyrene segments run. But for the moment, we expect those exporting styrene in the US to continue to focus, on the Far East, on India and Turkey, and to a lesser extent, Brazil. And that's going to be key because we don't see a lot of significant growth in the domestic derivatives markets. Again, a lot of this impacted by the pandemic, but we expect slower growth in, ABS, SBR, and polystyrene. And that is all I have. I appreciate your time, and if you have any questions, please feel free to reach out. You can reach me on my telephone number there listed, or the email address below at kevin.allen@spglobal.com. Thank you.
Good afternoon, everybody. My name is Rob Steer. I'm the Senior Lead for Global Petrochemical Analytics for S&P Global Platts, and I'm glad to be with y'all here today virtually. What I thought I'd do is start off my presentation with looking at what we presented last year. So for those of you that were in Buenos Aires last year and attended our Sunday conference, this was one of my very first slides, taking a look at what we expected to happen in 2020. And it's, I thought this was interesting because not much has changed. You know, we're still in an environment where there's a lot of uncertainty and volatility, especially today with the presidential elections. We still have the trade wars. Brexit over in the UK is still being negotiated. The price trends back in November last year were very bearish. The margin trends were neutral to bearish, as we had a lot of new supply coming on in the first and second wave of expansions in the US Gulf Coast. IMO 2020 turned out to be a non-issue, but it was something we had been talking about for many years, and the impact on the refineries. We still are optimistic that we're going to come out of this global pandemic with strong GDP, and that plastics will continue to grow above GDP. Single-use plastics bans and regulations are an ongoing issue that we have to address. And then our point of view at Platts Analytics is that plastics recycling is going to be a very long-term and complex issue, and that hasn't changed. So if you remember, one of the slides I put up last year was looking at an oversupplied petrochemical market. How low could prices go for specifically high density and linear low density polyethylene? So we went over these correlations, and the conclusion was in an oversupplied market, we could see polyethylene prices hit $600 a ton into the future. And lo and behold, because of the coronavirus and the aggressive Q2 sell-off this past year, we actually saw linear low density polyethylene prices go below $600 a ton. So that was a pretty accurate prediction as to, in an oversupplied market, you know, where prices could go. And you can see the highlighted red circle, and that's exactly where prices went to in April and May of this year. Broke the $600 a ton level. And that's an important number. Remember that $600 a ton level for later in the presentation. So where are we today? If you look at what's happened over the past year and then our forecast looking into next year, well, it's all about the elections, which are taking place as I speak today. I know this presentation is actually going to be viewed a little bit later, and we'll know the results of the election, but we still have a lot of uncertainty and volatility, trade wars. The current petchem price trends are bullish as opposed to bearish this time last year, and they're bullish because of all of the hurricane outages that we've seen take place in the US Gulf Coast. We're at a record level, and in fact, there's a hurricane hitting Guatemala as we speak, and it's amazing how quickly these hurricanes intensify. I believe the hurricane is a Cat 4, which is just unbelievably strong and devastating. Our 2021 margin forecast is bearish. It's really driven by just too much supply, regardless of our optimistic demand forecast. We just have capacity that overwhelms demand, and the margins will be all about outages. If everyone runs well in 2021, we are going to be in a low margin environment all year. Of course, we're waiting for the election results. Trump would be bullish for US petrochemicals just because he has been relaxing environmental regulations, allowing fracking, really pushing energy independence, and is not very concerned about recycling or environmental issues. And you can say the opposite for Biden. A new Biden administration would restrict fracking on federal lands. The whole green philosophy and recycling would take a bigger position in the Biden administration. So there's very different outlooks depending on who wins the election for the next 4 years. We're still very optimistic that global plastics demand will remain above global GDP. Relative to there is no alternative, in our opinion, for single-use plastics that have the same economic benefits, the environmental footprint and the circular economy long-term opportunities. The big change from last year is we've replaced IMO 2020 with a global pandemic, and looking at how we're going to recover from the pandemic as Europe and the United States are going through a second wave as we speak, contrasted to Asia that's recovering very well. So you have a very dislocated pandemic recovery where Asia's coming out of it and seems to have contained the virus, but Europe and the Americas are still suffering and struggling to contain the virus and may end up in a second wave of shutdowns. Not much change for single-use plastics and regulations. Short term, we don't feel that there's any significant impact to plastics, at least looking through 2021, 2022. It's a very long-term and complex issue. So where are we? What is our assumption for 2021? Right now, our base case assumption is we will be able to contain the second wave outbreak. So we're going to follow this latest outlook, the red line, knowing that there's a risk that we could head into this winter and see more outbreaks, more requirements that businesses shut down. We don't think it would be as bad as what happened in the March-April timeframe, but it could be more bearish if that takes place, especially in Europe and the Americas. And even if Asia manages to keep growing and recovering, an outbreak in Europe and the Americas would be very, very bad for the first half of next year. The global ethylene market has held up very well. So if you look at the demand for ethylene and its key derivatives, mainly polyethylene, they're really used in consumer packaging, which is grocery store items. So we expect positive demand growth for ethylene and polyethylene this year, even including the first half weakness. Contrast that with some other products that go into more durable applications like polypropylene and specifically butadiene, which is primarily used for synthetic rubber for tires. Butadiene prices collapsed and didn't really start recovering until the last 2 months. And now they're overshooting to the upside, and butadiene prices have skyrocketed in Asia as they recover, and the supply has been restricted because of the coronavirus and the lower production during the second quarter and into the third quarter. But there's, again, a big dislocation between consumer packaging and personal protective equipment that a lot of polypropylene fiber would go into. Those markets have been very strong. Disinfectants, isopropyl alcohol, many products that have been helping combat the coronavirus have seen strong demand growth in 2020. A company like Clorox has done very well, whereas the automotive companies, clothing, retail has done very poorly. And we're hoping to come out of this and see a much better performance across all of these industries in 2021. So how are we looking at next year? And we all talk about the recovery alphabet, and the first one was a V-shaped recovery. We go down and see the bottom of the recession in April and May, then a strong recovery into the second half of the year. And that's a good way to describe what we've seen happen in Asia. Asia has experienced a V-shaped recovery so far. However, in Europe and the Americas, we expect a W-shaped recovery, and in fact, a repeating W-shaped recovery. And what I mean is we've seen prices, collapse in the second quarter, rebound into November. Right now, we're seeing the highest prices of the year across all of the commodities, again, mainly due to outages and the recovery in demand from the Q2 lows. But we don't expect high prices and high margins to be sustainable in an environment where supply is greatly exceeding demand. So if you look at what's the good parts of what we expect next year, producers have done an excellent job managing Inventories, they've done a good job cutting operating rates, shutting down plants to manage their global supply chain. And that's very impressive. And right now inventories are on the low side. So there's no need for producers to be aggressive going into the end of the year to sell excess inventory. They don't have it. Polyethylene demand has been very good. PVC demand has been improving, and there's a lot of issues around PVC, force majeures, and caustic soda right now that we expect the PVC market will be very tight next year. That's one of the highlights. Polypropylene demand for personal protective equipment's done very well. And as we see a rebound in a second wave of infections, that demand will continue into the early next year. Of course, the best cure for prices is low prices. So cheap polymer prices will stimulate demand and make it more difficult to replace single-use plastics. Again, what do you replace a PET 2-liter bottle with that's cost-effective, environmentally friendly, and recyclable? We haven't identified those products, so we have a longer-term, a more favorable view of virgin demand, as the recycling demand is either going to be mandated or legislated. But on the face of it, recycling on an economic standalone basis is difficult to justify. The trade wars may result in everyone wanting to, made in America. You hear that in some of these rallies that President Trump has held. And that's a feature where more people are going to want to simplify their supply chains and make products in the country as opposed to exporting or importing them. The one good part of recycling is if you have high quality food grade recycled material, that's commanding a big price premium over virgin, but those products are hard to find, which is why the prices are higher than virgin materials. So that's got to be an area where the industry makes an investment to get higher quality food grade material or higher quality, high density and polypropylene that can displace virgin polyethylene and polypropylene and not go into an application that doesn't replace virgin, downgraded into making roads or plastic lumber or flower pots, something you traditionally wouldn't see virgin material go into. Chemical recycling is something that we believe has a long-term impact and a long-term opportunity, but that's way beyond the next few years. That's going to be the later part of the 2020s. And then feedstock optionality is always a benefit in this volatile market where you can take advantage of the cheapest feedstock to make ethylene and improve your margins in a low margin environment. Looking at what's not going so well, low density polyethylene, polypropylene, and PET, they are also oversupplied, but these polymers will recover much faster than the overbuilt high density and linear low density markets. Most of the ethane crackers that have been built in the US Gulf Coast have high density and linear low density plants behind them as the derivatives, in addition to ethylene glycol. So that's where the overcapacity is going to be, really felt. But the other products, low density polypropylene and PET, although they're going to have a few difficult years, by 2023, they should come out of the oversupplied situation, and we can see margins improve and the justification for additional capacity. Styrene margins are going to be very volatile. The whole aromatics value chain is being aggressively overbuilt in China, really driven by the polyester fiber value chain, so clothing, to a lesser extent PET bottles. But much of the expansion we're seeing in Asia for petrochemicals is focused on polyester. And again, that would be clothing, fill for stuffed animals and furniture. And that's going to be the demand driver to soak up all of that aromatics capacity in Asia and specifically China. Refinery grade propylene is an interesting product because it's been a byproduct of the FCC gasoline making unit for years. We expect it to continue that way, given the lack of transportation fuel demand that we expect at least over the next year because of COVID and lots of people continuing to work from home. And naphtha, aromatics, alkylate, the gasoline blending components. Again, if your gasoline markets are long, then these products have to find either alternative applications. And what happened in March and April is naphtha discounted all the way into the ethylene cracker to provide almost negative ethylene cash cost for a short period of time, as naphtha was trying to find demand because gasoline blending literally stopped in the April timeframe when everyone was locked down in their cities. The real difficult products that we're going to see next year are the high density and linear low. The polyester chain, ethylene glycol, paraxylene are overbuilt. Mechanical recycling for products like polyethylene and polypropylene are really going to struggle with low virgin material to make mechanical recycling volumes increase. Something's going to have to happen. Tax benefits, subsidies, consumer incentives like a deposit on the bottles need to change consumer behavior and give the economic incentive for the mechanical recycling business to grow. Otherwise, it's going to be very challenged like it has been over the past few years. Producer polymer profitability is going to be under pressure, going to see reduced operating rates and economic run cuts like we saw in the first half of the year. That'll take place again in 2021, and we expect even into 2022. Therefore, you could see industry consolidation, asset rationalization, producers shut down small, old, high-cost plants, and the recent Lyondell-Sasol joint venture is a good example of that industry consolidation, where Lyondell took an equity stake in the Sasol Lake Charles project, and it was a win-win for both companies. Talked a little bit about outages. One of the reasons we believe that margins and prices have rallied so strongly into October and November is because of outages. We did have a good rebound in demand from the second quarter, but that wasn't enough to really get prices and margins higher. It was the effect of 3 hurricanes, 2 that directly hit Lake Charles, the eastern part of Louisiana, and one, the most recent one, Zeta, that went over the New Orleans area. And all 3 have caused production outages across the value chain. The ones that were hurt the most are the chlorovinyls. So chlorine, caustic soda, EDC, PVC right now are in force majeure events, and we're seeing record high prices for PVC. And the same for ethylene prices spiked after Laura hit. Polyethylene prices are still elevated and peaking now in the early parts of November. And we do expect prices are peaking and will head lower as we go into the Thanksgiving and Christmas holidays. But want to emphasize how extreme the outages have been, not only in the Gulf Coast because of hurricanes, but also in Europe and Asia during the third quarter. And here's an impact of what those outages have done. So you can see the US PVC margin graph on the right. This is a one or 2 weeks old. Margins have even gone higher into the first week of November, but we're at record high PVC margins here as we sit in early November. And we expect the margins to continue into the balance of 2020 and next year at 5-year seasonal highs. Offsetting that is a very weak caustic soda market. And as you may know, you produce 1 ton of chlorine and 1.1 tons of caustic soda as co-products. And right now, caustic soda demand is very weak. Prices are falling to multi-year lows. And basically, if you need more PVC, the only way you can get it is to make more caustic soda, which would have to be discounted in price and probably end up in storage. So there's a big imbalance between caustic soda and the need for chlorine to meet the EDC and PVC demand. And that will continue through next year. Looking at the feedstocks, I mentioned earlier that during the second quarter, when we went into the global shutdowns and transportation fuel demand pretty much got cut in half. Jet fuel demand got cut by 90% and still is struggling to recover. The left graph shows you the price of ethane hit $1.35 per MMBTU. So ethane during the March and April timeframe this year was selling at the same price as natural gas. And therefore you would reject a lot of ethane and keep it in the natural gas stream and just sell it as a BTU value. But you can see the BTU values for all products collapsed during the second quarter and have since recovered nicely. Then the right-hand side shows you a graph of making ethylene in the US out of ethane. The cost of production went below $200 a ton for most of 19 and early 2020. European naphtha actually went negative. So naphtha price got so low where you can convert naphtha to ethylene and the co-products. The co-products, propylene, butadiene, and aromatics, provided such an uplift that when you did the cash cost feedstock minus co-product credits, you came up with a negative number for ethylene. So you could actually sell ethylene at any positive price and make a margin. And you can see that's didn't last very long. And now we're back to the $400 a ton type cost of production for all three feedstocks. So that's leading into a situation where everybody has favorable feedstock economics to produce ethylene and derivatives. This graph shows what happened from 2014, which is the top red line, all the way through our expectations for 2020 through 2030. Back in 2014, the difference between the high cost producer, at 140 million tons on the bottom axis relative to a North American ethane cracker was $1,000 a ton. This was the golden age of petrochemicals for the North American shale producers. From about 2010 to 2015, North American ethylene producers enjoyed the highest margins ever. But that's not the case anymore. If you look at our supply stack today in 2020, that $1,000 spread has decreased to only $300. So there's a 70% reduction in margin just based on the cost comparison from the high cost producer in Asia to the low cost producer in the US Gulf Coast. And that's going to put pressure on everybody's margins going into 2021. We also have seen a situation where we are going to be pulling more ethane out of the nat gas stream over the next 2 years to satisfy the demand for the new crackers that are starting up and to offset the reduced wet gas supply because of the shale oil production, reduced production because of the price war that took place. We're below $40 for WTI. That's not a real good incentive to increase production. And we don't believe that production is going to increase fast enough to keep up with the ethane demand, both for domestic consumption and for exports. So we're calling for, by this time next year into 2022, ethane could approach 40 cents a gallon. And it hit 8 cents a gallon earlier this year. So that's over a 4 times increase in the price of ethane in the next year or two, again, which will pressure margins for US producers and for those that export US ethane to Europe, Mexico, Brazil, and Asia, India. They're all going to have to pay much higher prices for ethane. So the supply curve, looking at a little more granularity, what's happening is the feedstock flexibility enables you to take advantage of, if you're an ethane cracker, but you can crack propane and butane during the summer, you can increase your margins as much as $100 a ton. And the same for international naphtha crackers that can take LPG or propane or butane. During the non-high demand periods for LPG, which is usually from March to September, you can get very cheap feedstock relative to your baseload ethane in the US or naphtha internationally. And that enables you to increase your margins by a couple $100s a ton in a oversupplied LPG market. This is a snapshot of demand. So, back in February, March, when the coronavirus really took place, we thought demand could collapse, and it did collapse for PVC and polypropylene because the housing market just shut down, construction shut down, automotive production shut down. So that's where you see the year-on-year polypropylene and year-on-year PVC sales go almost 15 to 20% negative, while polyethylene, which is much more consumer non-durable applications, held up pretty well. And as through the latest statistics we've seen from the American Chemistry Council, everything's positive now year to date, except for polypropylene. And that can be explained by the weak automotive, appliance, and carpeting demand. So very good performance relative to global GDP. We're expecting to be down about 4% this year, but polyethylene demand will be positive. Looking into next year, on the right-hand graph, we are expecting a very strong rebound. So I just mentioned our global GDP forecast is about -4% for 2020. Very front-end loaded in the first half of the year. We expect a very robust global economic recovery next year, between 5 and 6%, assuming that we don't have a second wave of the pandemic really take fold in Europe and the Americas, which would give us a very strong demand growth next year, coming off the very weak demand growth in 2020. Even in light of this very strong demand growth that we're forecasting, we're still bearish on prices and margins because the capacity that's coming online this year and next year overwhelms any increase in demand. And that capacity, as shown here, is really focused on the North American shale gas feedstock advantage, and then China, where they're building a lot of petrochemical facilities that are integrated with the refinery. So last year, one of my presentations was oil to chemical facilities, and we're going to see more and more of that going forward, where a refinery is integrated with a multi-feed ethylene cracker that can upgrade the refinery streams into higher value-added petrochemicals. And that's a trend that'll continue for the foreseeable future. And as again, the market, you can see on the right-hand graph, is still dominated by naphtha feedstock and ethane feedstock, and propane and butane will swing. If we have a really cold winter, you probably won't see any propane or butane consumed as a petrochemical feedstock until late next summer. But if we have a warm winter like we did for the 2019-2020, where it's way above normal in most of the Northern Hemisphere, then we'll come out of winter with plenty of LPG inventory, and you can see a lot of LPG cracking starting in March around the world at the expense of naphtha and ethane. So here's a snapshot of how much capacity is coming online. So 2020 was just an extraordinarily high amount of capacity. A lot of that was delayed from 2018 and 2019, and is finally getting started up in 2020. But we still have 6 to 8 million tons a year of capacity starting up through 2023, and you can see that dislocation on the right-hand side, where from 2016 to 2018, we were running pretty close to at capacity. And if you account for all the outages, the plants during the past 4 years had to run pretty hard, and we would describe that as like 95% of effective capacity. Plants needed to run very well, and we had high margins good profitability. And then you can see the disconnect that started last year. We had a very weak Q4 last year, but it's getting worse as we head into 2020 and 2021. And that's where we think the margin pressure and low operating rates are going to be required to balance the market. All of the capacity that we're starting up in North America, especially in Texas and Louisiana, is going to go to the export market. Domestic demand in North America for polyethylene, polypropylene, PVC, polystyrene is pretty much flat. If you look at the past 5 years, domestic demand, the plastic pellets that are consumed in North America to make products, has been either side of zero. We believe that because of the trade wars and the made in America, made at home type changes, we do forecast positive demand growth in the Americas, specifically the US and Canada, as we make more trash bags in the US and import less film. So it's good news for a plastics converter. They'll be able to increase their volumes at the expense of imports. But the US really needs a robust global market to move all of these new molecules offshore. And Europe is unfortunately one of the recipients of this expanded capacity. So Europe is going to be under a lot of pressure. We're forecasting lower operating rates in Europe as they have to absorb the material that's going to be exported. And it's an export push from the United States into these markets. It's not a demand pull from Europe. So basically the US prices have to discount to open the ARB and make a profitable sale into Europe. Europe's not going to increase their prices to attract imports. The US will have to discount prices to make that trade happen. So we expect much lower operating rates in Europe for the next couple of years as a result, because they are a high cost location with older naphtha crackers, and they will be challenged to be competitive in this environment. And again, a snapshot of the polyethylene trade flow. You can see we're going to be increasing our exports out of North America. South America will be getting slightly more short, so they'll have to continue to price to attract imports. Africa, relatively flat, because we're including Egypt and some other countries in there that are expanding capacity. If you look at Europe, both Western and Eastern Europe, pretty much balanced. So outages will really have a big impact on how Europe has to price to either attract imports or de-incentivize imports if it's long. And then the Middle East is slightly growing, more imports or exports than all the growth's taking place in China, Southeast Asia, and India. So the real bet that the global petrochemical market's making is we're building capacity to satisfy very strong demand growth in Asia. Here's a snapshot of the operating rates that we are forecasting for all three grades of polyethylene. So you can see we were operating in the mid to high 80s from 2015 to 2019. Then the new capacity all hit the marketplace starting late last year and this year, going into the next few years, and we expect operating rates to be in the low 80s, which does not allow for margin recovery. So high density and linear low density are overbuilt, going to be under pressure. Low density polyethylene, because of the delayed startups of the Sasol and Formosa plants in the Texas and Louisiana area. In fact, I think they're still starting up as we speak here in November. That's allowed low density polyethylene to continue to have high prices and margins, and that product will also recover first because it hasn't been overbuilt like the other two grades of polyethylene. And if we look at our price forecast, we go back to that slide earlier where in November of 2019, last year at APLO, when we started saying how low could prices go, and the conclusion was $600 a ton, we hit $600 a ton in the March-April timeframe. Well, we're forecasting to go back to those price levels by the end of next year. So for all three grades of polyethylene, high density, linear low, and low density, especially once the two new low density plants come online and the US becomes a net exporter of low density, we're looking at some retesting the lows from Q2 on polyethylene prices going into next year. Shifting over to propylene for a second, the big driver here is we still get about 40% of our propylene supply globally from refineries, from the FCC unit that's designed to make gasoline. So there's a lot of uncertainty with the COVID pandemic and the lower transportation fuel demand, gasoline versus jet fuel versus diesel fuel. These are all making it very difficult for refineries to optimize their yields and profits. So we did see a big reduction in propylene supply from the refineries earlier this year, which meant that the PDH units, the propane dehydrogenation units, PDH units, had to run harder. And that's a theme that could extend into next year, where you're getting as much propylene from the refinery as possible, and the refinery is just a price taker. They have not set the price for refinery grade propylene in many, many years. But the propane dehydro units are the price setter now. So it's a propane based price setting mechanism for propylene rather than a gasoline price setting mechanism for propylene. If we look at the demand, we talked about it a little earlier, but the global propylene and polypropylene demand, we're estimating is going to be down about consistent with the GDP. So if global GDP is down 4%, propylene demand and polypropylene demand this year, we expect down about the same percentage compared to polyethylene that's going to have positive, growth, but maybe only 1 or 2%. But still positive. The propylene and polypropylene value chains are not seeing that same strong demand because of its exposure to more durable applications. So the price forecast that we have for propylene and polypropylene is very different from polyethylene. It's much more stable. You have cost pressures. We are constructive on propane prices into next year because of the NGL supply reduction based on the shale gas. We're exporting less propane, producing less propane over the next few years because of the reduced supply out of the Permian Basin and the reduced supply of wet associated gas. So that basically you just don't have as much propane to extract out of the associated gas for sale to either the petrochemical market or the residential and commercial markets. So that'll help keep propylene and polypropylene prices a lot more stable relative to polyethylene prices. And looking at the impact of recycling, especially a snapshot of polyethylene, what we see is the graph here describes global total demand in the blue line, which is virgin plus recycled material that replaces virgin. So you can think of a Tide laundry detergent bottle recycled back into a Tide detergent bottle or a motor oil bottle, as opposed to being recycled and downgraded and used in a road aggregate. That we do not consider recycling. But the impact over the next few years is going to be relatively low. We do not expect increasing volumes of recycled polyethylene to make its way into the marketplace that displaces virgin. We expect that to accelerate starting about 2024, 2025, when companies really gear up and view recycling as a core part of their business. producers look at this as a utility, a cost center, and it's the cost of doing business to meet the demand for a more circular economy where we get more recycled content into the products, and the consumer is willing to pay a higher price for a more environmentally friendly product with a higher recycled content. But it's going to be challenging, as I mentioned earlier. Mechanical recycling on a standalone basis in today's environment is not profitable. So looking at it over the long term, you can see that the yellow line is the total feedstock displacement as you account for all the recycling that's taking place today on a global basis for polyethylene, polypropylene, and PET resins, and they're displacing the need to make virgin. Well, right now in 2020, we're displacing about 700,000 barrels a day of feedstock that you don't need to consume because you're providing that polymer via recycled material. But we expect that to almost double, going up to 17, 18, well, that's 1.7 million tons of feedstock. So over the next 10 years, mechanical recycling, even though it's not profitable on a standalone basis, we believe the company commitments, the recycling mandates, the producer commitments to be more circular and more green will result in about 1 million barrels a day of feedstock demand being displaced by recycled material. And that's all I have. And thank you very much for your time.